this is not that much different than we talked about last time. Notice where the US is. We're kind of between mid and late stage of an expansionary cycle. But we're far enough from mid to late that I want to talk about, just like in January we talked about potential for probable volatility, I want to talk about what will a recession look like. Let's say it happens. How is it going to be? The average market decline between World War II and .com, what do you think the average decline in markets was? 25%. And it's difficult for me to say outside of, and it's all things that are possible, right? But the probabilities are low that we have a real protracted, mean trade war. It's a low probability outcome. If it happens, then we could probably see a 40%. But things are going so good in terms of jobs, in terms of earnings. Wages are slow to pick up. They're always the last things to pick up. When unemployment is, and probably by mid-2019, we'll see unemployment at 3%. There's no employees left to hire. The number we're seeing grow faster than other numbers are people who leave their jobs voluntarily. In May, 3.5 people left their jobs voluntarily. Why'd they do that? Because they had better jobs, right? That number is improving almost every single month. So when people leave their job to find a better job, their employer that they just left has to hire somebody else, or close down, right? So if they have to hire somebody else, what do they have to do to find that person away from the other employee? There's no one out there to hire. Wages come. And they're coming, and it's slow and it's agonizing, but it's coming. The downside of wages, what's the downside of wages, of higher wages? I was going to say lower profits, but sure, it leads to inflation too. And potential inflation means more Fed action, so you have lower profits from higher wages, and you got more Fed action, so you got a higher cost of capital. Given where unemployment is, given what the employees, can you imagine a moment, 3% unemployment? Let's imagine that for a second. How long can we go until you need a surgery, but there's not enough doctors? Or you need to build something, but there's not enough contractors, or you want to open a restaurant and there's no chefs. Like, we're bumping up against that. So that wage growth is coming. But we're mid to late. So we see some credit tightening. We see earnings aren't really under pressure now. Neither real earnings nor pre-tax, neither pre-tax earnings or post-tax benefit earnings. Growth isn't falling. Credit growth might be declining a little bit. So we're right at the mid to late stage. So when I'm thinking about that potential recession, it's not one of these major recessions. There's nothing there that thinks it's all going to melt down. And it's very possible to have a 15% or 20% or 25% decline and have a recession and come out of the recession very quickly. There's no indicator right now, whether you look at leading indicators or coincident indicators or lagging indicators, there's no indicator of recession right now. I've looked at dozens and dozens and dozens of these. There's one that I found that says there's a 20% chance of a recession in the next 2 years.